Hi everybody, in this video I'm going to go through a dividend calculator that will track how much your quarterly, monthly, or annual dividend payments are, and look at a goal that I'm having with my own personal budget in terms of being able to retire with a certain amount of money each month in just dividend payments. We're not going to look at share price appreciation, we're going to look at different factors of the current dividend yield and the dividend growth rate to determine what might be an adequate solution for be reaching my goals in the future. Let's get right to it. Okay, for this particular example, I'm going to be looking at VYM, which is the high yield dividend growth fund, essentially, high yield account for Vanguard. And when you look at VYM, the dividend yield is currently at 4%. The 5-year growth rate is 8.29%, and it's been growing for 10 years. If you look at the dividend growth tab in Seeking Alpha, you'll see 5-year growth rate at 8, 10-year growth rate at 9, and you do have a fairly steady increase in dividends. So we're going to work with my current account value is about $62,000 in a Roth IRA. Let's assume I'm going to add $5,000 to a Roth IRA. This is about $4 something a month. And this is all in a Roth IRA, so no dividend tax rate. We're going to distribute quarterly, just like VYM does. And we're going to try different percentages of dividend yield and dividend increase. I'm going to go 0% price appreciation, although in the long term it probably will go up a couple of percent here. And 26 years when I turn 65, so that should be an adequate time for me to look at my dividends. When I click calculate dividends, you'll see the total account value, and we're just at $1 million. Yield on cost ends up being pretty high in 26 years. Again, I don't necessarily assume 3 and 7 is lower than what VIM is doing, so I want to be a little bit more conservative with it. My annual dividend income will be $187,000 a year, and a total dividends of $780,000. You can see each year the annual dividend will be increasing based on the $5,000 of contributions I have, the growth of the previous year's dividends. So when you get to the 26th year, your annual dividend will be about $148,000. Divide that by 12 months, and we're looking at $12,000 a month in dividends for pretty reasonable numbers. I mean, I'm pretty sure I could save $5,000 a year. 3 and 7 might be unreasonable. It's hard to say, but I think since the last 10 years we're 4 and almost 10, 3 and 7 seems a bit reasonable. Next, if we look at more yields, like Realty Income, for instance, they pay a slightly higher starting yield and a lower growth rate. A lot of REITs will do this, by the way. So the real estate investment trusts will have to pay out up to 90% of their earnings in dividends, which doesn't allow them to grow the dividend as quickly as some of the bigger large cap companies in general. The Realty Income currently is paying about 4% in dividends, and the growth rate is about 4 to 5% in the very long term. The 4.32% currently, 5-year growth rate 4.38. Look at the long-term dividend growth. We're looking at about 4 to 5% in the last 10 years, so about 4.75%. So similar numbers, 62 grand to start, 5 grand per year to add. Let's do 4% yield. Let's change this to 4% dividend increase. Calculate, you will see the last year, in 26 years, we'll be making $69,000 in dividends. So it actually is a little bit lower than the first situation because the dividend growth rate is not as high. Even though the initial yields, or the initial dividends, 2480 compared to 1881, obviously the first few years is going to be higher because you have a higher starting yield. If I take $69,280, divide that by 12 months, we can get $5,723 a month in dividends when I'm 65 years old. So 26 years is a very long period of time. If I change this to just 20 years, you're going to see the number dramatically decrease because all those reinvested dividends. Instead of $69,000, we are looking at about $30,000. The last 5 years will significantly increase your dividends. So looking at these particular numbers for my situation, I'm pretty confident that I could, one, invest $5,000 a year. I've been doing more than that in the last few years anyway. With my wife in nursing school, we're paying for that out of pocket as well. So in a few years when my wife is working as a nurse and we have no debt, we'll be able to save significantly more than this. But it's good to know that 26 years from now, with my teacher pension, again, I'm the investing teacher, high school science teacher, teaching others how to invest, will be more than adequate with our teacher pension. Should be replacing about 80 to 85% of my pay the rest of my life when I'm 65, and then these additional dividend payments should be good. So in terms of investing philosophy, VYM could be perfectly adequate of the only holding that I could use for the next 26 years. I like to diversify a little bit more than that, so I have individual companies like Realty, Main Street Capital, New, and I'm starting to look more into the essentially blue chip companies like AT&T, Intel, Broadcom, MasterCard, Visa, and I do have a smaller one called Flick, which is First Long Island Corporation's a bank, local bank there with good dividend rates. So what I'd recommend everyone else do is look at what your current payment is, look at how much you're able to contribute each year, use similar numbers that I did, like in VYM, which anyone could easily invest in. Is very low expense ratio of 0.06%, and see what numbers that you'll need in order to see what we're going to get. So whatever numbers that you've been doing, maybe take the average of what you've done the last year, put that in on the annual contribution, and see what the dividend payments are. If that's not going to be adequate when you're retiring, then you have a few options. One is stretch it out a few extra years. As you saw in the video, 6 extra years is significantly higher in your dividend payments. You could up the contributions that you're making if you're pretty low and you still want to retire at a certain age, and look at different avenues for additional income. Okay? So if you have any questions, feel free to let me know. Again, I'm the investing teacher, teaching others how to invest. Like, subscribe, smash all that buttons that you know, and I'll see you guys next time.